First occasion in history. Gold closes above $5,000 weekly. Russia says no to dollar return. This is not a headline. This is a documented structural fracture. While most were distracted by market noise, something unprecedented occurred in the global monetary system. A weekly close that has never happened before in human history. A geopolitical rejection that cannot be reversed. And a regulatory enforcement from the East that threatens to collapse the entire Western paper gold structure. Three forces converging simultaneously. Bloomberg tried to manipulate what you believe happened. Russia made their position unmistakably clear. And China just pulled the trigger on enforcement that could unravel decades of market control. The mathematics are no longer theoretical. The timeline is no longer distant. And the consequences are already in motion. Welcome to Metal and Macro. If you've watched financial markets long enough to remember when gold was under $300, when dollar dominance seemed permanent, when central banks were still pretending fiscal discipline mattered, then you understand why this channel exists. We'd be honored if you'd subscribe. Not for entertainment, but because the information shared here may prove essential in the months ahead. And please, take a moment to tell us in the comments, where in the world are you watching this from? Because what's unfolding now affects every currency, every economy, every business decision being made today. Let's begin. For the first time in recorded financial history, gold closed a weekly trading session above $5,000 per ounce. This was not a fleeting moment, not a temporary spike caused by panic, not an intraday fluctuation that disappeared by settlement. This was a sustained weekly close, a threshold crossed and held. To those unfamiliar with market mechanics, this might seem like just another number, another milestone in an endless series of price movements that financial media reports and promptly forgets. But to those who understand how monetary systems function, to those who study the architecture of global finance, rather than simply react to its headlines, this weekly close represents something far more significant. It represents confirmation. When gold trades above a certain level for a few hours, it can be dismissed as speculation. When it closes a daily session above that level, it suggests momentum. But when it closes an entire week above a historic threshold, when that weekly candle solidifies on the chart with no reversal, it signals that a new price floor has been established. And price floors are not created by speculation alone. They are created by structural demand, by central banks, by sovereign entities, by institutional forces that operate with multi-decade time horizons and balance sheets measured in trillions. The technical distinction matters enormously. In modern precious metals markets, there exists a persistent gap between what trades on Western exchanges and what settles on Eastern delivery platforms. The Shanghai Gold Exchange consistently shows premiums over London spot prices. Physical gold in Asian markets trades at higher levels than paper contracts in New York. This divergence has been widening for years. What changed this week was not simply that gold reached $5,000. What changed was that this price level held through an entire weekly settlement cycle, despite coordinated efforts to shake confidence through media manipulation. And that brings us to the structural forces at work. Central banks have been net buyers of gold for 15 consecutive years. Not speculators, not retail investors chasing momentum, central banks. The very institutions responsible for managing national monetary policy and currency reserves. They have been systematically accumulating physical gold while public attention remained focused on stock markets, cryptocurrencies, and real estate. The question any serious analyst must ask is simple. Why? Why would the institutions that issue currency, that control interest rates, that manage the very mechanics of the monetary system, choose to accumulate an asset that generates no yield, pays no dividend, and serves no industrial purpose? The answer becomes clear when one examines the broader monetary context. Global sovereign debt now exceeds levels seen at the end of World War II, not in absolute terms, but as a percentage of global economic output. Developed economies are carrying debt loads that would have been considered mathematically impossible to service just 2 decades ago. Central banks have expanded their balance sheets to unprecedented sizes. They have purchased government bonds, corporate debt, and mortgage securities at scales never before attempted in peacetime. And they have done this while claiming inflation was temporary, while insisting monetary policy remained sound, while reassuring markets that systemic stability was never in question. Gold's movement above $5,000 per ounce on a weekly close is not occurring in isolation. It is occurring against a backdrop of currency debasement, fiscal unsustainability, and monetary policy that has exhausted its conventional tools. When currency loses purchasing power, hard assets reprice. This is not theory. This is historical pattern repeated across every major monetary transition in recorded history. The Roman denarius, the Spanish silver real, the French assignat, the Weimar paper mark, the Zimbabwean dollar, the Venezuelan bolivar. Every fiat currency that lost the confidence of its users experienced the same phenomenon, a repricing of real assets against depreciating paper claims. Gold's breach of $5,000 is not a cause of monetary instability. It is a symptom, a measurement, a signal that the gap between official monetary policy narratives and underlying economic reality has grown too wide to ignore. For business leaders, this creates a strategic imperative that cannot be postponed. Contracts denominated in depreciating currencies lose value even when nominally profitable. Supply chains, dependent on stable exchange rates, face disruption when monetary systems fragment. Treasury reserves held in government bonds or bank deposits erode in purchasing power, even as nominal values remain unchanged. The weekly close above $5,000 is not entertainment. It is not a trading signal for short-term speculation. It is confirmation that the monetary ground beneath the global economy has shifted, and that those who fail to recognize structural change will pay the highest price when recognition becomes unavoidable. On a Thursday morning, Bloomberg published a story that moved markets within minutes. The headline suggested Russia was considering a return to the dollar-based international payment system. Gold dropped. Silver fell sharply. Currency markets reacted immediately. Traders responded as they always do to breaking news from major financial outlets. They assumed the reporting was accurate, and they positioned accordingly. Except the story was false. Within hours, Elvira Nabiullina, the governor of Russia's central bank, issued a public statement. She confirmed that no such discussions had taken place. No talks, no consideration, no involvement whatsoever in any proposal to return Russia to dollar-dependent transactions. The entire narrative had been fabricated. This was not a case of misunderstanding nuance or misinterpreting diplomatic language. This was not an error in translation or a confusion of sources. This was the publication of information that had no factual basis. Information that immediately influenced billions of dollars in market positioning. Information that created exploitable price movements in precious metals markets. And then it was quietly corrected. But the correction received far less attention than the original false headline. By the time the truth emerged, positions had been liquidated, stop losses triggered, and market momentum artificially reversed. This is how modern information warfare intersects with financial markets. What makes this incident particularly significant is not simply that Bloomberg published false information. Major outlets make errors. What makes it significant is the strategic timing and the specific narrative being pushed. The false story served a particular purpose, to suggest that Russia's move away from the dollar was temporary, reversible, a negotiating tactic rather than a permanent strategic realignment. But Russia's actual position tells a very different story. Since 2022, Russia has systematically restructured its entire international trade framework, not as a negotiating position, not as a temporary sanction response, as a permanent reconstruction of how it engages with the global economy. Russian energy exports to Asia now settle primarily in yuan and rubles. Trade agreements with India involve rupee-ruble exchanges that bypass dollar intermediation entirely. Gold plays an increasingly central role in facilitating non-dollar transactions with trading partners who remain skeptical of purely fiat alternatives. This is not rhetoric. This is documented policy implemented across Russia's largest trade relationships. The Russian central bank has been among the most aggressive accumulators of gold reserves over the past decade. Even before sanctions accelerated de-dollarization, Russia was steadily diversifying away from dollar-denominated assets. Why? Because Russia observed what happened when the United States froze Afghan central bank reserves, when it sanctioned Iranian oil revenues, when it weaponized access to the SWIFT payment system against nations deemed adversarial. Russia concluded that holding reserves in a currency controlled by a potential adversary represented unacceptable strategic vulnerability. This conclusion was not unique to Russia. China reached the same conclusion. Saudi Arabia has begun exploring alternatives. Brazil, India, and South Africa have all signaled interest in trade mechanisms that reduce dollar dependency. The BRICS nations collectively represent over 40% of global population and a growing share of global economic output. When these nations begin coordinating alternative payment systems, when they establish bilateral trade agreements that exclude dollar settlement, when they accumulate gold as a neutral reserve asset acceptable to all parties, the network effects that have sustained dollar dominance for 8 decades begin to reverse. And network effects, once reversed, accelerate rapidly. The dollar became the global reserve currency, not because of American military power alone, but because of convenience. Because it was easier to settle international trade in a single widely accepted currency than to manage dozens of bilateral exchange rates. But when that single currency becomes a weapon, when access to dollar payment systems becomes conditional on political alignment, when reserves can be frozen by executive order, the convenience calculation changes. Nations begin asking, what is the cost of continued dollar dependence versus the cost of building alternative systems? For decades, the cost of building alternatives seemed prohibitive. The dollar system was too entrenched, the infrastructure too established, the switching costs too high. But technology has changed the equation. Digital payment systems can be constructed far more quickly than previous generations of financial infrastructure. Bilateral trade agreements can be negotiated and implemented within months rather than years. And gold never required technological innovation. It has served as a neutral settlement asset for 5,000 years precisely because it belongs to no nation and answers to no central authority. Russia's rejection of a return to dollar dependence is not a temporary position subject to negotiation. It is a permanent strategic realignment based on Russia's assessment of where global monetary architecture is headed. And when Bloomberg published a false story suggesting otherwise, when markets were deliberately misled about Russia's actual position, it revealed something equally important. There are powerful interests invested in maintaining the illusion that dollar dominance is secure, that de-dollarization is reversible, that the current monetary system will persist indefinitely. But illusions, no matter how carefully maintained, eventually collide with reality. Russia has made its position clear, not through diplomatic ambiguity, not through negotiating postures, through documented action that restructures how it conducts international commerce. And for businesses operating across international borders, this creates immediate practical implications that cannot be ignored. Currency risk is no longer theoretical. While Western markets were distracted by the Bloomberg fabrication, China moved quietly. No dramatic announcement, no press conference, no theatrical unveiling of new policy, just a regulatory update published through official channels, the kind of bureaucratic notice that usually passes without international attention. Except this particular notice has the potential to dismantle the entire architecture of Western precious metals price control. China's Shanghai Gold Exchange and Shanghai Futures Exchange issued new enforcement rules governing off-exchange gold and silver trading. 4 specific provisions were outlined, each one technical, each one seemingly administrative, and each one designed to force physical delivery in a market that has operated for decades on the assumption that physical delivery would rarely be demanded. The first provision prohibits leveraged derivatives in precious metals outside of officially regulated exchanges. This sounds mundane until one understands what it actually eliminates. For years, participants in Asian markets could take positions in gold and silver through off-exchange contracts that never required physical settlement. These instruments allowed massive leverage, allowed traders to control large notional positions with minimal capital, and most importantly, allowed synthetic supply to be created without any corresponding physical metal. China just made that illegal. The second provision mandates physical delivery for all precious metals, contracts that reach maturity, no cash settlement option, no ability to roll positions forward indefinitely without taking delivery. If a contract reaches expiration, physical metal must change hands. This is not how Western markets operate. In London and New York, the vast majority of precious metals contracts settle in cash. Traders close positions before delivery dates. Those who do request delivery often receive warehouse receipts rather than actual metal. The system functions smoothly as long as everyone agrees to trade paper claims rather than demand physical possession. But what happens when the largest physical demand center in the world, the nation that consumes more gold than any other, suddenly requires actual delivery? The third provision eliminates rehypothecation of precious metals. This term may be unfamiliar to those outside financial markets, but its implications are profound. Rehypothecation is the practice of using the same physical asset as collateral for multiple financial transactions. A bar of gold sits in a vault. That bar is used as collateral for loan A. The same bar is then used as collateral for loan B, and potentially for loan C, D, and beyond. On paper, multiple parties believe they own or have claim to that single bar of gold. The system works as long as not everyone demands physical possession simultaneously. China just outlawed this practice within its jurisdiction. The fourth provision requires full transparency regarding the location and allocation status of all precious metals held on behalf of clients. If an investor owns gold through a Chinese institution, that institution must now verify that specific allocated metal exists and disclose exactly where it is stored. No more unallocated accounts, no more pooled storage arrangements, no more ambiguity about whether metal actually exists or whether clients hold merely a claim against a general pool. Each of these provisions, taken individually, appears reasonable. Taken together, they represent a direct assault on the fractional reserve model that has governed precious metals markets for decades, and the timing is not coincidental. China has watched Western precious metals markets operate for years. It has observed the persistent gap between paper prices set in New York and London and physical premiums paid in Shanghai. It has documented the concentration of derivative positions held by a small number of bullion banks. It has studied the historical cases where regulators uncovered spoofing, manipulation, and coordinated price suppression. China concluded that Western paper markets do not reflect genuine supply and demand for physical metal. They reflect the positioning of leveraged traders and the interests of institutions that benefit from price suppression. And China has decided it will no longer allow its domestic market to be influenced by a pricing mechanism it views as fundamentally corrupted. The mechanics of how this affects global markets are straightforward. When paper contracts can be settled in cash, unlimited synthetic supply can be created. A bank can sell 1,000 gold contracts without owning any physical gold. If buyers accept cash settlement, the bank never needs to acquire the metal. This selling pressure depresses prices even though no actual gold has changed hands. But when physical delivery is mandatory, the equation changes completely. Now that bank must either own the physical gold before selling the contract, or must be prepared to purchase it at market prices upon delivery demand. This constraint limits how many contracts can be sold. It forces price discovery through actual physical availability rather than through derivative positioning. For decades, Western markets operated under the assumption that Asian buyers would continue accepting prices set by Western paper exchanges. That assumption is now being tested. If Chinese markets require physical settlement while Western markets continue operating on fractional reserve principles, arbitrage should force price convergence. Traders should buy cheaper Western paper contracts and demand delivery, then sell the physical metal at higher Eastern prices. But arbitrage only functions when regulatory regimes permit it, when capital can flow freely, when counterparty risk is minimal. China's new regulations create jurisdictional separation. Metal delivered in China stays in China under Chinese rules. Western institutions cannot easily extract physical gold from Chinese vaults to cover short positions in London or New York. This creates the possibility of sustained price divergence. Eastern physical markets trade at premiums that Western paper markets cannot suppress because the physical metal needed to close that gap remains trapped within separate regulatory jurisdictions. For businesses holding precious metals exposure, this creates a critical question that must be answered immediately. What exactly do you own? If a company holds shares in a gold ETF, does that ETF own allocated physical metal or merely unallocated claims? If precious metals are held through a bank custody arrangement, are those metals specifically allocated or part of a pooled account? If investments involve derivatives or futures contracts, what happens if physical delivery is suddenly demanded across the market? These questions were theoretical when paper and physical prices remained closely aligned. They become urgent when the world's largest physical market implements rules that force delivery while Western markets continue operating on assumptions of cash settlement. China has not announced war on Western precious metals markets. It has simply required that within its jurisdiction, gold and silver transactions must involve actual gold and silver. But that simple requirement, if enforced, has the potential to expose how much of the Western pricing mechanism depends on metal that does not exist. 3 seemingly separate events have converged within the same narrow window of time. Gold closed above $5,000 on a weekly chart for the first time in history. Russia publicly rejected any consideration of returning to dollar-based settlements. China implemented regulations forcing physical delivery in precious metals markets. Each event, analyzed in isolation, carries significant implications. But their simultaneous occurrence is not coincidence. It is convergence, and convergence accelerates consequences. Throughout history, monetary systems have transitioned through recognizable patterns. The transition is never announced through official policy. It is never declared by central banks or formalized through international agreement. It emerges through accumulating pressure that eventually overwhelms the existing structure's ability to maintain equilibrium. The 1971 Nixon shock followed this pattern. The United States did not plan to abandon gold convertibility. It was forced to when foreign central banks began demanding physical gold in exchange for accumulated dollar reserves. The mathematics became untenable. The gold window closed not because of strategic vision, but because continued convertibility would have drained Fort Knox. The system changed because reality demanded it. The 1980 precious metals peak followed a different pattern, but arrived at a similar inflection point. Gold reached over $800 per ounce. Silver briefly touched $50. Central banks responded with coordinated interest rate increases that deliberately crashed their own economies to restore currency credibility. The cost was severe recession, but the alternative, allowing gold to continue rising, would have signaled complete loss of monetary control. The system stabilized, but only through intentional economic destruction. The 2008 financial crisis represented yet another pattern. Decades of debt accumulation and derivative leverage created systemic fragility that collapsed when housing prices declined. Central banks responded with unprecedented monetary expansion. They purchased trillions in assets. They drove interest rates to zero and then below zero. They transformed their balance sheets into mechanisms for absorbing bad debt that private markets refused to hold. The system survived, but only by abandoning every principle of sound money that had previously governed central banking. Each of these historical episodes shared a common characteristic. The gap between official monetary policy narratives and underlying economic reality grew too wide to sustain. When that gap becomes unsustainable, the system adjusts violently. What distinguishes the current moment from previous crises is the absence of remaining conventional tools. In 1971, central banks could raise interest rates to defend currency credibility because sovereign debt levels were manageable. In 1980, governments could tolerate severe recession because debt to GDP ratios remained below 50% in most developed economies. In 2008, central banks could expand balance sheets because their previous balance sheets were relatively small and offered room for expansion. None of these options exist today. Sovereign debt across developed economies now exceeds 100% of GDP in many cases. Japan's debt to GDP ratio exceeds 250%. The United States carries debt equivalent to its entire annual economic output. Europe faces similar arithmetic across multiple nations. Raising interest rates to defend currency credibility would make debt service costs mathematically impossible. The interest expense alone would consume tax revenues, leaving nothing for government operations. Central bank balance sheets have already expanded to unprecedented levels. The Federal Reserve's balance sheet peaked above $8 trillion. The European Central Bank holds assets exceeding 50% of Eurozone GDP. The Bank of Japan's balance sheet exceeds its nation's entire economic output. Further expansion offers diminishing returns while creating accelerating risks. This is the context in which gold closed above $5,000 on a weekly basis. This is the environment in which Russia formalized its rejection of dollar dependence. This is the moment when China moved to force physical settlement in precious metals markets. The convergence is not coincidental because the underlying pressures are interconnected. When currency loses purchasing power, nations seek alternatives. When alternatives emerge, network effects that sustain the previous system begin reversing. When network effects reverse, the transition accelerates beyond the control of any single institution or government. Gold's repricing represents a measurement of this process. It is not causing monetary instability, it is reflecting it. Just as a thermometer does not create fever, rising gold prices do not create currency debasement. They measure it. For business leaders, the strategic implications require immediate assessment across multiple dimensions. Currency exposure must be evaluated not simply across current operations, but across long-term contracts, debt obligations, and reserve holdings. A contract promising payment in dollars 5 years from now carries embedded currency risk if dollar purchasing power declines significantly during that period. Even if the nominal payment arrives as specified, the real value received may be substantially less than anticipated. Supply chains dependent on stable exchange rates face disruption when monetary systems fragment. If major trading partners can no longer settle transactions through a common currency, if bilateral agreements replace multilateral systems, if capital controls restrict cross-border flows, the friction cost of international commerce increases substantially. Treasury management strategies designed for a stable monetary environment become inadequate when that stability disappears. Holding cash or government bonds preserves nominal value, but not purchasing power if inflation accelerates. Holding equities provides potential inflation protection, but introduces volatility and concentration risk. Holding physical assets provides inflation protection, but creates liquidity constraints. There's no perfect solution. There are only trade-offs that must be evaluated based on each organization's specific circumstances and risk tolerance. But what cannot be sustained is the assumption that the current monetary system will persist indefinitely without significant disruption. The weekly close above $5,000 is documented fact. Russia's rejection of dollar return is official policy. China's enforcement of physical delivery is regulatory reality. These are not predictions. These are not scenarios. These are events that have already occurred. What happens next depends on whether decision makers recognize structural change while options remain available, or whether recognition arrives only after disruption has eliminated those options. The cost of preparation is measured in attention and strategic adjustment. The cost of delayed recognition is measured in crisis response under constrained circumstances. History teaches that those who recognize monetary transitions early bear adjustment costs. But those who deny transitions until they become undeniable bear catastrophic costs. The mathematics are no longer theoretical. The timeline is no longer distant, and the consequences are already in motion. The only remaining question is whether those responsible for protecting organizational value and ensuring operational continuity will act on information while action remains possible, or whether they will wait for consensus that arrives only after the cost of adjustment has multiplied beyond all reasonable proportion. Gold closed above $5,000 on a weekly chart. Russia formalized its monetary independence. China enforced physical settlement requirements. The convergence has occurred. The implications are clear, and the window for strategic response is narrowing with each passing week.